Yeah. Yeah. Oh, currently, huh? Yeah, nice. Oh yeah, for sure. Kind of it was a different time. Not tremendously smaller, but it was definitely a different time. Yeah, for sure. For sure. Are you in Fort Collins then?
Yeah.
So he's, oh, okay. I was gonna say then he probably went to the local high school, but probably not then.
No. New Hampshire.
I was just there this time last year in Burlington. Oh, I was in Vermont. Sorry.
Oh,
I was in
Vermont.
Yeah.
Yeah.
Well, we did get briefly, is Woodstock in New Hampshire? Is it still in?
That's Vermont.
Okay, but it's close to the border though, right?
Yeah.
Yeah, that's as close as we got. That's as close as we got. Well, we were cycling, we were riding the bike.
Oh, you're right.
Yeah, so only as far as your legs would take you. Yeah, I mean, it was right in the middle of September, so I was a little bit early for color change. But when we flew up,
You should go back.
oh, yes, yeah. We flew out of Burlington towards the end of the month, probably like the 20th, and we flew over the Adirondacks, and they were already changing, so that was really pretty. But
Yeah, that's one thing on this year. I don't think you get quite the
in town, you did get some reds and purples, but up in the mountains now, it's gold or nothing,
Yeah.
and it's very short. Oh yeah, love them.
Yeah.
Oh, well, okay.
Yeah.
I'm looking, so.
Yeah.
Beautiful.
So your son's going to CSU, you're like, man, I want to live out there. Is that how that worked?
Pretty much, yeah.
Really?
Yeah, there was like, my husband passed away.
Oh, I'm sorry to hear
that. And like we were in central New Hampshire, and there's really not much there.
Right.
So
Right.
I just decided, I followed his college.
Yeah,
basically.
It's Fort Collins is it's a great community, very friendly, still small-ish, but not.
He came to visit last March. It was his favorite history teacher at Condo Questionnaire. Started talking to Jeremy about it. So, well, we have to get out of New Hampshire anyway, so let's go visit. And ironically, we came like right before that massive snowstorm. Remember that big snowstorm last March? We got like 2 feet in one day. So I was like, maybe
It does
we have to
happen.
rethink this.
It does happen. It doesn't hang around long in March, but boy, that's when you get the most.
Hey guys,
I had rented.
It does.
Not really. Thank you very much.
Oh, that's great. No, I hope you like it down here.
Careful it doesn't blow your dress out.
Then we'll go viral.
Yeah, I was gonna say, then we'll go viral. Maybe you should turn it on.
You guys want to stay on that side? Are we ready?
We're good?
If you're ready, we're ready.
Great. All right. Hello, everyone. We are going to get started today. Thanks so much for joining us here. My name is Sophie. I am the Colorado Alumni Engagement Specialist here at the CSU Alumni Association. And I just want to thank you all for participating in this both in person and for our folks online here. Many of our attendees are CSU Alumni Association members and Campus Credit Union members as well. So thank you all again so much for your membership. It makes events like this possible. We are going to get started tonight, and my colleague Dakota will be including more information in the chat about membership for those of you joining virtually. And we will be sending out the recording of this webinar as well and some additional resources after tonight. So please be on the lookout for that later on. Later on in this event, we will also be putting a survey link in the chat as well. So if you could please take a moment to fill that out, we would also greatly appreciate your feedback. And once again, I just want to thank you all for being here tonight. We are really excited to be working with Campus Credit Union for this, and I'm excited to introduce you to Chad, Aspen, and Josh from Canvas.
Thank you.
All right, thanks everybody for coming. Appreciate it. We're gonna kind of just take turns here. I'm gonna start first, and then I believe Aspen, and then Josh will finish us up. So obviously, this is a class about buying investment properties, thinking about buying your first property, possibly an investment. So by attending this seminar today, you're likely looking for a way to create some extra income and then on an investment property while expanding your real estate portfolio. There's certainly a lot to consider, including financing, cash flow, legalities for landlords, insurance, and even your risk tolerance. We will be discussing the benefits, opportunities, and considerations related to owning an investment property tonight. So let's take a look at what we'll be covering. There we go. So you want to be a landlord. So here's a little bit about what we'll be covering today. We'll start with the initial discussion on the benefits and opportunities of becoming a landlord, as well as some of the risks to consider. We'll then go over the lending requirements for the financing of an investment property. Third, we'll cover some of the tax implications of owning an investment property, as well as some of the legal considerations. We'll end with some resources to continue your learning. We're going to try to do a poll here. For those online, you can enter into the chat if you'd like. For those here, feel free to speak up if you'd like to share. But I'm just kind of curious why some of you are attending. Are you already a landlord, considering your first rental property, wanting to switch the kind of rental you have? And then secondly, where are you looking to be a landlord? Is it here in Northern Colorado, Metro Denver, Southern Colorado, Western Slope, out of state? Anybody want to chime in?
Sure, looking for retirement income.
Okay.
And geography really isn't that much of a concern.
Okay.
Local would be great, just for logistics reasons.
Sure. Makes
Anywhere,
sense.
yeah.
Okay.
Ditto.
Ditto. Okay.
Yeah, just looking, but really want to stick to Fort Collins.
Okay. Stay close. Perfect. Thank you, guys. Anybody online have anything to say? Nothing? Okay. And feel free to ask questions throughout this. Just stop us, raise your hand if something piques your interest, and Dakota will let us know if we have any questions online. So you want to be a landlord. So we'll start the discussion here with some things you should look into 4 to 6 months before you plan to purchase an investment property. All right. So these are some of the things we're going to go over. So, starting with, direct or indirect landlord. So the first question you're trying to answer for yourself by attending this seminar today is, am I ready to be a landlord? Sure, you've maintained your primary residence on your own home for some years now, but what factors do I have to consider in managing a rental property? Am I ready to be available 24 hours a day, 7 days a week to handle any emergencies or repairs my tenant might have with the property? If you are, then you can certainly be in a position to maximize your rental income profits. However, you may already have a full-time job that doesn't allow you to be available for the kinds of hands-on attention it requires. If that is the case, then researching property management companies might be a consideration. While these types of companies do take a percentage of your gross monthly rental income, they should have a full-time staff available to handle any needs by your tenant. Many will offer assistance with preparing the lease contracts, as well as which could alleviate one of the legal areas that you might be apprehensive of. Investment property ownership is a source of wealth and retirement income for many Americans and a source of stress to others. Please know yourself, your abilities, both financially and with maintenance, and think strategically before jumping into the landlord ownership adventure. Next is saving for the down payment here. Besides the emotional considerations, there are several financial things that you'll want to consider before starting, your perfect search for the investment property. Unlike purchasing a primary residence, financing an investment property does require a bigger down payment or investment from you. So the minimum down payment on a 1-unit investment property is at least 15% of the purchase price. So you got to have at least 15% down to get into an investment property. It goes up from there on multi-unit properties, and we'll have a slide on that coming up here with Aspen. While using maximum financing, meaning putting only 15% down, it will result in higher interest rates, higher closing costs. Keeping more of your assets in your account, though, will allow you to tackle repairs and upgrades you may want to accomplish prior to getting a tenant to maximize the rent you receive. In addition, if your goal is to add additional rental properties to your portfolio, then having those funds earmarked for additional properties may be worthwhile. So your down payment goes in 5% increments typically. So we say 15% down. The next logical step would be 20% down, 25% down, etc. The sweet spot is kind of in that 25 to 30% range. 40% down gets you in the best possible tier as far as interest rates go. And then one other consideration when you're putting the minimum down, you do have mortgage insurance. So when you only put 15% down, that's less than that magic rule of having 20% to avoid PMI. So you will have mortgage insurance to consider. Credit reports. So keeping an eye on your credit score is obviously very important for everything, not just buying rental properties. It's a good idea to check your credit score, check your credit report. If you're not used to regularly checking on this, you may want to, think about doing it about 6 months out, so that you have time to, tackle any potential issues that may arise that you may not have been aware of that could, derail your plans. And then in addition, you may want to try and raise your credit score to improve your interest rate position. Let's see, debt to income ratios. The debt to income ratio is something that we look at when reviewing the application. This is basically your monthly debt payments divided by your gross monthly income. So debt payments include your mortgage, car loans, credit cards, student loans, any court mandated or other loan payments that you may have. If your ratio is above 40%, it will be more challenging, but may not be impossible to get a mortgage. You may need to focus on paying down some of your debt to help get that ratio lower to improve your chances of qualifying. Any questions on any of this stuff so far? Good? Okay. All right. And then finally, understanding your average rents. So you can search for monthly rent information on the internet, but it's a lot easier to have your realtor help you with that. Types of properties, checking in on what types of properties are the highest in demand for rent. Locations, obviously being around CSU, there's a high demand for student, housing and whatnot. Is it a 2-bedroom, 1-bath condo where you might be competing for renters with apartment complexes, or is it a 3-bedroom, 2-bath single-family residence ideal for families who are looking to get out of the shared walls apartment life and want a bit more space? Will the rent income be enough to cover the mortgage payment and any HOA dues and ideally provide you with some positive monthly cash flow? Or will you be operating in the red each month with a slight loss? Your realtor and lender can work with the numbers to help you find the ideal price range and the property type you're most comfortable with. All right, so here's a example here of a rent versus buy scenario. So you've got rent for a 2-bedroom apartment here listed at $2,466. When you're renting, you typically have a homeowner's insurance policy that covers your contents more or less. We've got $25 listed there, so your total payment is about $2,491. On the flip side, the median condo sale price was approximately $400,000. So we use that as an example, assuming a 6.25% interest rate with 25% down. This shows a loan amount of $300,000. This is based on a 30-year term, credit score of 740. Unfortunately, that rate has gone up since this slide was created just a few weeks ago. So we're kind of hovering in the low 7s right now, give or take for interest rates. But that being said, in this example, you've got your principal and interest payment here, so the mortgage by itself, property taxes, homeowners insurance, HOA for a condo or a townhome. You're going to have a homeowners association to consider, and then that brings you to your total payment here of about $2,358. So in this example, you've got a positive cash flow here of about $133 a month, barring any other expenses. Any questions with any of this stuff? All right. So credit score, touched a little bit on that already, but obviously your credit score is super important. It affects your interest rate, the mortgage insurance that we discussed, and then your homeowner's insurance rates can also be affected by your credit score. With the mortgage insurance, typically the higher your credit score, the lower that monthly payment will be, and vice versa. The lower your credit score, the higher the mortgage insurance will be. And then also your down payment is a consideration in that. We just have a little tip here to, pull your credit, which we'll talk about here on the next slide. So how can you get a copy? On annualcreditreport.com, you can go on that website and you can pull your credit report one time per year per bureau for free. So encourage everybody to do that, at least once a year with one of the bureaus. When you're buying a house, we pull all 3 bureaus of for your credit scores, and we take the middle score, and that's the score that's used for qualifying. So if you haven't done this in a while, it's usually best to pull at least 2 bureaus, because that way you have enough overlapping information to make sure that you're seeing everything and you know where you stand. They will try to upsell you for credit scores and credit monitoring services. Just make sure you decline that stuff. That's not the purpose of this. Is just to be able to review and analyze your credit. All right. I think Aspen, you're up.
Thanks. I was super prepared for that. So another question to ask yourself is, like, when you're planning to do this, are you planning to do it, in the next 6 months, in the next year, or maybe a year from now? And then also what kind of property you want to invest in. And the different properties for that are like a single family home, a duplex or a fourplex, if you're looking into a condo, or even if you're looking to change your primary residence into a rental property. So there are a lot of components to consider when you are going through that, what we're going to finance and everything. Loan to value, Chad already mentioned that you need at least 15% down on any investment property that you're considering. 20% down will get you out of paying mortgage insurance, and mortgage insurance does fall off at like a predicted point on its own, but it's kind of a good idea to keep an eye on that. As soon as you get to about 78% loan to value, you can, kind of bring evidence in to say, hey, I don't want to have mortgage insurance on there anymore. Can we take that off? But initially, it has to be 20% to not pay mortgage insurance, but you have to have a 15% down payment. The lower your loan to value, the more benefits you have. You'll have a lower interest rate, your closing costs will be different, your monthly payment will obviously be different. We're also going to talk about qualifying income and like what it means to be, self-employed income, or like W-2 income, or any other types of income. And then we are also going to talk about the different types of properties and what risks those have when it comes to having a mortgage on those. And then Josh is going to handle the assets part of that and the owning multiple properties. So this is kind of going over the loan to value. And I know that this is a solid chart, so we highlighted the most important parts for us. This is thinking like, hey, we're going to go out and buy a townhome or a single family home. We're super excited. We need at least 15% down. These interest rates, depending on the day, could be right now. This is our monthly payment. And then, so the thing that we're trying to highlight here is if you have 15% down, your monthly payment will be $3,126 and some change. But if you bump that up to 20% down, not only does your interest rate come down, and I'm aware that that's not a lot, but it will drop your monthly payment to $2,807 and some change. The biggest thing to focus on there is not only is your monthly payment dropping, but with that savings and interest over time, that will like turn into a significant savings. Now, there's nothing to say you can't refinance that to a lower interest later, but that is definitely something to consider, that just upping your down payment will drop your mortgage payment quite a bit. And then obviously over here to 25%, Chad already mentioned that the sweet spot is, 25% and more. So you can see that even going from 15% to the 25% is almost a full point. Well, it's more than a percentage whenever those rates were taken.
Yeah, rates change on a daily basis.
Yeah.
So while we could have made this slide yesterday or made it today, tomorrow
I think it was
rates
done on
will
the
be different. It's not always, and sometimes they stay the same, sometimes it'll fluctuate. Obviously, we all know that earlier in the year there was a big jump in interest rates.
Right.
But even on a daily basis, there can be a little bit of fluctuation.
Yeah, exactly. Down here at the bottom, it says savings over 60 months. With the 15% down, there's obviously no savings. But if you dump or bring in 20% down payment, you'll have $18,000 in savings. 25% is $40,000, and that is money that you could turn around and put into a new investment property, or I don't know, go to Tahiti. And then this slide is this slide is going over a breakdown of what your monthly payment will be. So when we send you a loan estimate, it's going to have your principal and interest, your property taxes, your homeowner's insurance, if you have mortgage insurance, and an HOA is also something that we have to associate with the home. Like if you are buying a condo, even though we will not pay the HOA out of your escrow, we still have to consider it because it's a cost associated with the home. So the biggest thing to point out here is that the down payments, obviously at 15%, we still have $153 in mortgage insurance each month. And that is definitely money that you can use in other investments. So if you have the capability, the closer you can get to 20%, or if you can get to 20%, that would be ideal. This is my favorite part. So qualifying income. And I'm saying that because it's very hard sometimes when you make money, like if you have a side job, there are different rules for just about every piece of income that you can bring in. So if you have pay stubs or W-2s, that's pretty cut and dry. We want your W-2s and we want your pay stubs to verify that. There are different rules though with overtime and commission income that don't follow the regular like base salary income. If you are self-employed, then we would need usually your past 2 years of tax returns. Sometimes it's 1 year, but usually it's 2 years. And your most like current up-to-date profit and loss statements. If you're looking to use your retirement income, pension, Social Security, like any annuities or like reoccurring retirement disbursements, that's pretty easy to document. We would just need the letter from whatever institution is giving that to you, or we can look at your past bank statements and verify that. It's not a bad idea to think about if you're getting alimony or child support or rental property income. Alimony and child support, though, you do have to consider how long am I going to get this, because If it's less than 3 years, then we can't include that. And then rental property income, there's like several different rules about that. So if you have a rental property income you're wanting to use, like just give one of us a call and we can kind of go over the basics of all of that.
It's something a realtor would help you out with as well before you, went under contract on a property. When we order the appraisal, we will actually get the rent schedule. But, beforehand, if you're trying to obviously look at your finances and make an informed decision, a realtor should be able to help you figure out, around what your rental income is going to be.
And if you are planning on using like your primary home for a rental property and you're going to move in with your best friend down the street, then we can order an appraisal on your property and order the rent schedule from the appraisal, and they will look at, surrounding areas with rental properties and give us like an idea of what that is so that we can use that for qualifying income.
Any questions on any of that?
Oh, I skipped one.
Okay.
So for the types of properties you have, there are single family homes and townhomes that usually they don't have a lot of risk associated with them. So it's pretty easy, cut and dry with that. There's not going to be a huge impact on your interest rate regardless of your down payment, but like we said, the more the merrier. Condominiums, those do have more risk associated with them. So when you go to your condo, if you have a condo, we're going to have to order something called a Condo Questionnaire from the HOA. And that's where we're kind of confirming that the HOA is staying on top of maintenance for the condo. We're also looking to see if there's any issues with maybe contractors that have done work for the condo and then the condo's homeowners, like insurance doesn't want to pay for it. We'll look for those issues. Another big issue we are seeing with condos, especially in college towns or in big cities, is if there is a condo complex, if more than 50% of that is used as investment properties, then it's going to be a non-warrantable condo. Canvas still can lend on that. It's just going to change the,
It's higher risk. The interest
Yeah.
rate's going to be higher.
yeah.
There's other things with condos too, like litigation with HOA or the management team on the property can also cause a condo to be non-warrantable.
So you're definitely, if you're looking into a condo, you want to ask the HOA, is this warrantable or non-warrantable? And they should be able to tell you that. Those are the biggest factors that we kind of look for right off the bat to save, them time and everything.
It's not that condos are bad. It's just
Yeah, no,
we're
it doesn't mean
we're,
that.
we're looking
Sorry.
out for our members as much as we are looking out for the credit union from an investment risk standpoint.
Yeah. That doesn't mean your condo is going to fall down or anything. It
No,
just,
it can
it
be
just could be a risk.
it could be simple as legalities with the HOA that has
Exactly.
nothing to do
And
with
as
the
soon
actual
as that
property.
clears up, it becomes warrantable again.
Yeah.
So, and then 2 to 4 unit properties, that does have minimum down payment of 25%. There could be like an interest rate fluctuation. Now, sometimes people will buy like a 4-unit property and they'll live in one of those properties. If that is what you're looking for, the down payment doesn't change, but the fact that you can use it as a primary residence interest rate instead of an investment property interest rate is going to be huge. So if you do end up buying a duplex and you live in one of those, you need to be like forthwith with it and tell us so that we can get you the better interest rate. Yeah. And that's me.
Okay, cool. Well, hello everyone. I'm Josh. For those of you online, I've met everyone here already. Wanted to talk about assets and acceptable sources of funds versus unacceptable sources of funds. So acceptable sources of funds can be examples of established checking, savings, brokerage, and retirement accounts. Keep in mind with acceptable sources of funds, you need to have 2 months of documentation of them. So for example, if you come to us and you say, hey, I want to buy an investment property. My uncle just gave me, $200,000 for a down payment a couple days ago. I want to go. They're not going to accept that. They're going to want to see that it's been in your account for at least 2 months. Equity from your primary residence. Great example. A lot of people who own a primary home now, as I'm sure many of you do, you got a lot of equity in your house over the last couple of years. What Canvas and other credit unions can do is you can get a HELOC, a home equity line of credit on your property as a second lien, and you can use those funds to actually make a down payment on a new property. Now, keep in mind when you do that, obviously your HELOC balance is going to have a monthly payment on it, and that monthly payment will affect the debt to income ratios, which we spoke about earlier. So sale of appraised assets. So you can do anything from a coin collection to your baseball card collection. Those things take a little bit more time. You need to actually have like a registered appraiser look at them and, actually have a document showing that you sold them for that amount. So you can't just, go down the street and sell your baseball cards to your friend and take the money and say, hey, I made all this money from baseball cards. Other things, settlements, IRS refunds. Unacceptable source of funds are gifts. So for a primary residence, you can use gifts from family members and employers, but on an investment property, you cannot. Same with cash advances and loans not secured against an asset. So if you're thinking, I can just go online and take out, a personal loan for $20,000 and use it to help me out, you can't do that. And same with cash on hand. So if you do have money that you are hiding in your mattress or a cookie jar, put it in a bank and keep it there for 60 days because, when we do, review through a file of someone that's looking to buy a property, we look at 2 months of bank statements. So, liquid financial reserves. So, when you're buying a primary home, you don't need reserves, but when you're buying an investment property, you do. So there's a calculation of reserves for multiple finance properties. Obviously, you can read the amount of percentage used for the UPB is unpaid principal balance. So that's what's left on any loans you have for other properties. It's based on the total number of properties you own. So if you own 4, it's 2%. If you own 5 to 6, it's 4%. If you own 7 to 10, it's 6%.
It's finance properties.
Yes, finance properties. So if you own a property free and clear, or you've paid off your mortgage, you don't have to worry about it. So here's a good example. If you, say this is the subject property, you're taking out a $78,750 loan on the property, and your monthly PITIA stands for principal, interest, taxes, insurance, and association fees. So it includes everything. Like Aspen was talking about, when you get a loan estimate, it has all of those fees. It's not just the principal and interest we take into account. So if you buy a condo and that has a $800 a month HOA fee, that would be accounted for. So you need 6 months for the subject property, which obviously you can see the calculation here. And then you can see the remainder of their loan. So this person has 5 properties, which means they're going to need 4% on the principal balance, and obviously this added up, you'll see, and then you take those two, so they need $18,457 in financial reserves. Now, financial reserves can be, if you have access to the money in a retirement account, we could use that. Now, it doesn't necessarily mean you need to pull from that account. So just showing that you have the money if necessary. It's basically just saying, hey, if something happens, you lose your job or your income stops coming in, that you do have a way to pay for an extended period of time. owning multiple properties. Okay, so financing limitations, the power of 10. Through Fannie Mae and Freddie Mac guidelines, you can only own 10 finance properties. So that includes your primary house, second home, investment properties, any properties you own that have a mortgage on them. Retire early with multiple streams of income. That's generally speaking when people start investing, they invest in one property and then eventually use the equity in that property to invest in another, and so on and so forth. And, converting your primary residence to a rental is an alternative route to consider. So, that's another option if you want to buy a new primary home instead and then use your current primary home as an investment property. Yes, legal resources, the IRS, your new best friends. Definitely. So we have a bunch of links here that kind of can show you the legalities behind what it is being a landlord and what rights you have and what rights tenants have. So definitely something you want to check out before you decide to invest in properties because, hopefully you get great tenants, but if you don't, you want to know, what you can do. All right. Fun with taxes. I don't know why the IRS slides say fun because I don't think any of it's fun, but Schedule E is a rental income form. So when you own rental properties, you'll fill out a Schedule E. Each of them can hold 3 properties. And after that, you just fill out another Schedule E. So if you keep detailed records of all your repair and maintenance expenses, you can actually deduct them. And the mortgage interest on your rental property is an expense, not a deduction. So if you're a really high interest rate, you can't use it as a deduction. If unsure, consult with a CPA, accountant, or tax preparer. With this portion of things, we as loan officers can give you some basic guidance, but really you need to have a tax professional look through these because.
And we'll just tell you to do that anyway.
Yeah, that's what we're going to tell you to do.
None of us want to lie to you.
Yeah, we don't want to lie to you. You have your CPA and accountant, you have an insurance agent. Insurance is, part of the deal. Usually when you get under contract on a property, you'll be referred insurance agents unless you have one that you've worked with on many properties. Investment or financial advisor, and that would be like a tax professional, for example, or someone that just goes over your finances. Real estate agent, really important, especially if you're buying a property. I'm sure many of you already own a primary home and know that as a buyer, you're not paying the agent, the seller pays the agent. So if you're buying a new property, you definitely want a real estate agent because they're going to make sure to do what's in your best interest. An attorney, especially if you're a landlord, that way you know your rights and you can protect yourself. And a mortgage loan officer, which would be us. So Aspen, Chad, and I, and then George was not able to make it because his dog was sick, unfortunately. But yeah, any questions anyone has, feel free to ask. We're here to help.
Either today or when
whenever you want.
it, like
Reach out anytime.
digest it a bit.
If you want to call me in 2 years, go for it.
Yeah.
Our
Gonna be
retired.
retired.
Are a little delayed, so I'm just gonna give them a couple minutes.
Yeah,
Okay.
that's
To
fine.
know that you're actually finished.
Sure.
One of the things I guess we can talk about quick is just kind of the market. I'm sure, many of you are here because you're interested in looking in the near future. I know that interest rates have risen, which stinks, but you're also not overpaying for the property you're looking at these days. You're seeing actually some price reductions or buying properties at value. Last year someone may have bought an investment property and been locked in at a 3% interest rate, but they also might have paid $50,000 over the value. Now, we do think that values are going to continue to slowly climb up, but more of like a 3 to 4% a year rate. That's typical rather than the 15 to 20% we saw through COVID. COVID rates and those equity gains hopefully will never come back, barring another world disaster. So, I know a lot of people compare the market now to the market then, especially if you're a first-time investor. This might even be a better time for you to invest because it's going to be easier for you to actually get a property and you're not going to end up overpaying.
Any questions?
Yeah, so for those of us that are considering the indirect option where somebody takes care of the management and everything for us, is there a kind of a rule of thumb in terms of what what their take from your monthly income would be? Is it like a 40% thing? I mean, I've heard that number thrown around. Is that?
I think it varies depending on what they offer and what kind of services you
So in
want.
each case, then you'd have to dig into it.
Yeah, that's
Yeah.
something you definitely want to look into beforehand and just maybe talk to a few management companies and see what their
I think
stipulations
I've
are.
heard as low as 15% and some as high as around 40.
Right.
Yeah.
Some of them
40
will-
more in the vacation type of.
Yeah, and I mean it completely hands off. Like
Mhm.
they don't even bother you. They just send you the check.
Mhm.
And they call them, but they just bill you for everything. So they got to call a plumber. They bill you for the plumber. They
Yeah.
Call fix the locks or
Right.
whatever. So it just depends on the level of engagement that you want.
Yeah.
On what they're going to charge, and obviously every management company out there has different different history, reputation, reliability, all that stuff. So it's definitely something that you will want to ask around, talk to your realtors generally have a pretty good relationship with one of those.
Yeah.
Did you have something to say on that? Oh,
I'd say generally speaking, when it comes to purchasing an investment property, a tax professional, a realtor, or a loan officer is going to be able to refer you to pretty much anyone you would need throughout the process, depending on who it is. So,
And if you're looking in places that are like, high Airbnb or like, if you were looking at Key West or something, you could ask the neighbors and everything, like, what do you go with? But I would definitely, like Chad was saying, like interview a couple different places to see which ones,
it's always good to get options.
Yeah.
Always good.
anything online?
They're there, but they're fighting through.
Yes.
Tell them to say something. Come on, guys. I know you have questions. We are available, I'm available weekends, evenings. So if you have questions, I know if you don't want to write them down and you just want to ask them, the cell phones on here are our personal cell phones. So we all have them on us all the time. So even if you just want to send a text for a question or set up a time to talk on the phone, we're happy to do that as well.
Yep.
So I know texting can be easier sometimes, especially for us very busy folk.
Yeah.
Okay.
Awesome. Thank you.
Yeah.
Yeah.
Thank you guys for coming.